So, good morning, everyone. This is Abhishek Mehrotra, Head of Investment Products with HDFC Securities. It's an honor to meet you guys again, and thanks a lot for taking time from your busy schedule and coming over the call. I know market has been challenging and things have been ups and downs over the period of last at least 2 quarters that we see. And to understand it more briefly, we have Mr. Vinod Bhat. I'll give a quick introduction of Mr. Vinod before we can pass on the discussion ahead. So Mr. Vinod is a portfolio manager with and equity strategist with Aditya Birla Sun Life AMC. Vinod comes with an overall experience of 2 decades in financial markets, and he is associated with Birla since July 2018. Prior to Birla, he was as a vice president in corporate strategy and business development with Birla Management Corporation. So in the same group, sorry. And previously, he has been an investment banker at Credit Suisse and Ocean Park Advisors in US. Mr. Vinod is a CFA charter holder and MBA Finance from Wharton School, University of Pennsylvania. He holds an MS in Industrial Engineering from Pennsylvania State University and a BTech in Mechanical Engineering from IIT Bombay. So, Mr. Vinod, the reason for having this interaction was a lot of our clients who have participated into your funds and also who are tracking market closely wants to understand what is your view on the current market, knowing that US, there's a lot of news about US recession, INR is depreciating, FIs have shown a negative trend over the last at least 2 quarters. There's a geopolitical tension, and in-house we have interest rate rising. So all our attendees want to know what is your view, how you are approaching the market, and how we are taking the funds ahead. So over to you, Mr. Vinod.
Yeah. Thanks, Abhishek. Good morning, everybody. It's my pleasure to be here with you for this session today. So what I'll do is spend about 30 minutes going through our outlook and some of our funds. And to start with, just to set the context, as we all know, Mahendra Singh Dhoni is one of our favorite captains, right? He's amongst the most popular. And the reason for that is his percentage of wins has been very high, right? And what drives that? One is his match awareness. He knows, what's the direction the match is going. He knows the pitch conditions. He knows what the team composition should be, right? Or which player to send in to bat, or which bowler should bowl, or whether to take the DRS review or not, right? And that is what has led to his success. So even for us as investors, what will be the key driver for our success is to have what we call the market awareness, right? And as Abhishek mentioned, there are a lot of developments that are going on globally as well as in India. So we need a simple framework that we can use to think of and analyze these events and what their impact on markets could be. And the way I tend to look at it is from a time horizon perspective, split it into short term versus medium to long term. So short term means the next 6 months to 1 year, and medium to long term means the next 3 to 5 years or more, right? So that is one angle, and the other is India versus the rest of the world, right? So let's look at the events and the impact and what we can expect the market to do, keeping in mind this framework. So if you look at the short term, so essentially this calendar year 22, I like to think of it as a year of 2 halves, right? So one half, what has already happened from Jan to June, right? What were some of the developments as you have all seen? One is the concern about high inflation. So what happened was the Russia-Ukraine conflict led to a spike in commodity prices. COVID-related lockdowns in China led to supply chain disruptions, and both of them contributed to high inflation. So for example, yesterday the CPI inflation in the US came in at a 40-year high of 9.1% year over year, which was higher than expectation of 8.8%, right? So what led that? It was high energy and other commodity prices, high food prices, services led inflation, and so on, right? So that concern about inflation is there. And the same thing we are seeing, whether it's in Europe, in Asia, or even in India, inflation was quite high in the first half of the year. Then what that led to was a change in the regime from quantitative easing to quantitative tightening, right? So what we saw was the Fed has started becoming very aggressive related to the rate hikes. They have already increased their policy rate from 0% to 1.5%. And at the end of July, at the next meeting, expectations are for 75 basis points to 100 basis point rate hikes. And if the Fed is increasing rates, then the other central banks have to follow them. So we are seeing whether it's the ECB, Bank of England, Bank of Canada, Bank of Australia, even RBI in India, all the other central banks are also increasing the policy rate to rein in the inflation. And the other aspect of this is, of course, that all the central banks are reducing their balance sheets. So the liquidity that was there in the financial system in 2020 and 2021, that is being reduced, right? So what is the effect of all this? The effect of all this is a slowdown in growth. So we are seeing over the past 2-3 months, economic growth estimates have been downgraded in the US, in Europe, and even for India, right? So US growth for this year is expected to be 0%, right? So we saw that in the March quarter, US GDP growth, real GDP growth was negative 1.6%. The June quarter is expected to be negative 1.2%. So technically, the US may already be in a recession. Europe, as we know, is very dependent on energy supplies from Russia. So we'll have to see what happens there. But the concern is that they might also go into a recession, right? But amidst all of this growth slowdown, the positive aspect was that the earnings growth estimates have remained resilient, whether in India, in US, or in Europe. There have not been any earnings downgrades. And that is one of the positive points for markets. But still, we have seen a market sell-off, right? So from a peak, NASDAQ has fallen about 30%, S&P funded about 20%, and India Nifty has fallen around 10%. And this fall has been mainly because of the normalization of the valuation multiples, like the price to earning multiple or the price to book multiple. So even the earnings were not downgraded over the past 6 months, the valuation multiples corrected, which led to the sell-off in the markets. And especially in India and other emerging countries, what we have seen as the FII outflows have been very significant. So year to date, India has seen outflows of about $25 billion. And since October last year, the total outflow has almost been about $35 billion. Of course, offsetting that has been a strong domestic inflows. So year to date, the domestic inflow is about $25 billion, which has completely offset the FII outflows. So this was what has happened over the past 6 months. So now the question is, what can we expect over the next 6 months, like July to December? And there we think it's going to be a somewhat different picture from what we saw earlier. So starting with the growth, like I said, we are already seeing a growth slowdown. The US may already be in a recession. Europe may enter a recession in the second half of this year. But the expectation is that these regions will enter only a mild or a shallow recession. It may not be a deep recession, but still it will have some impact on Asia and India, right? And because of that, we will most probably see earnings downgrades globally. So in India, the June quarter earnings have started getting reported. US also, they will start today. And the expectation is that more and more companies will highlight concerns about their margins. You know, commodity prices have gone up, wage growth has gone up, so it impacts companies' margins, and hence we will see some earnings downgrades. The other aspect is that as the global economy slows down, the demand for commodities cools off, right? And that will lead to reduced inflation. So the hope is that most probably inflation has peaked out, and we should see it going down from here on. So of course, the joker in the pack is the oil and gas prices. So that's what we are monitoring closely. As you know, Europe is highly dependent on the Russian imports, and if Russia cuts off gas supplies or the oil supplies get disrupted, then it will lead to a spike in oil and gas prices, and it will lead to higher inflation. So that is one key risk to monitor. But the base case view is that most probably inflation has peaked, whether in the US or in Europe or in India, and we should see it moderating going forward. And what that will lead to is a moderation of the rate hikes, right? So till August, September, the Fed and other central banks are expected to remain aggressive on hiking rates. But if inflation cools down, if there is a growth slowdown, then the central banks will take their foot off the pedal, and they may not be as aggressive in terms of increasing rates, right? Because growth will become a priority again. And because of that, we expect that the valuation multiples will start expanding again. FII flows will start resuming, and although the market may remain range bound till August, September, or even till November, December, we expect markets to recover after that, right? So that's the sense of the short-term view. So essentially, for at least the next 3 months, markets may remain range bound because we'll see some earnings downgrades being offset by some expansion in the valuation multiples, and after that we can expect some direction from the market and the recovery, right? So that's a short-term view. But the key question for investors is, what can we expect over the next 3 to 5 years, like in the medium to long term, right? And that's where we have to start from economic growth, right? So there, India is much better placed as compared to other countries. So what we have seen is US, Europe, and other nations were ahead of India in terms of the recovery from COVID. India has lagged them. We have just entered the recovery of the expansion phase, right? And now we are seeing the geopolitical conflict, higher inflation is leading to a global growth slowdown that will impact India also. But if you take a 3-year view, then we expect the Indian economy to outperform the other regions, because the 3 key drivers of any economy, which is consumption, investment, and exports, all of them are expected to do well in India over the next 3 years. So starting from consumption, given the structural drivers like the young demographic, increasing workforce participation of women, changing preferences, we expect, and of course higher incomes, higher aspirations, we expect discretionary consumption to increase. So the share of discretionary consumption in total consumption today is about 25%. We expect that to increase to about 40% by 2030, and that will be one of the key drivers of the economy. On the investment side, we have seen that the government's focus on infrastructure development continues every year. In the budget, they increase the amount budgeted for infrastructure development, so that is a good sign. We have seen that the real estate cycle has seen an uptick since last year, and that is also a big driver of investments. The various reforms like the production linked incentive scheme, or the PLI scheme, is leading to a lot of interest and investments both from Indian companies as well as foreign companies, and that is kickstarting some investments. So these are the positive aspects. But as far as the private capex, or the investment by private companies in setting up new plants or purchasing new equipment is concerned, we think that may still be a year or year and a half away, because the capacity utilization is still about 74%. It needs to increase to about 80% before companies start thinking about making new investments. But overall, government capex and real estate should drive the investment. And lastly, on the exports, we saw since last year itself, exports from India had recovered because the global economy was doing well. For the next 3 to 6 months, we may see some pressure on exports because of the global economic slowdown. But here too, India is a key beneficiary of the China Plus One model being followed by a lot of multinational companies, where they want an alternate supplier to China, and they evaluate India, Taiwan, or Bangladesh and other countries to set up their second plant. So many sectors such as textiles, specialty chemicals, and other manufacturing segments are seeing a lot of benefit. So companies are setting up plants here to export out of India, right? So to summarize, over the next 3 years, we expect the 3 key drivers, consumption, investment, and exports, to fire, and our real GDP growth rate to go back to its structural trend growth rate of 6.5 to 7%. And if you add 5.5 to 6% inflation to that, then the nominal GDP growth comes to about 12.5, 13%. Okay, and that's a key number to monitor, because whenever our growth does well, it means corporate profitability can also be expected to improve. So we saw over the past decade, the corporate profitability to GDP ratio was on a consistent downtrend from almost 8% to just 2%. Over the past 2 years, surprisingly, we have seen it increasing again. It's gone back to about 4.5%. And if our economy does well over the next 3 years, we can expect corporate profits to improve and this ratio to continue improving. And if that happens, it's a good sign, because it means that earnings growth will be strong, right? So as far as investments in equity is concerned, the single fundamental factor which drives equity markets is earnings growth. And we think that over the next 3 years, the earnings growth for the Nifty could be in the range of 13 to 15% per year, which is much higher than the last 10-year average of about 11%. And what will drive this? So various sectors, like, for example, the banking and financial sector and the telecom sector, which were making losses over the past decade, have turned around. They have become profitable. So those will do well. The commodity sectors, like, metals and mining, oil and gas, the PSUs, which were not doing well, they have been booking record profits. We expect them to continue doing well. And lastly, the secular growth sectors. So whether it's consumer staples, consumer durables, IT, all these sectors will also continue to do well. So that will, as the economy does well, corporate profits improve, the earnings growth should also improve, and we expect it to be in the 13 to 15% per year range for the next 3 years. The concern which investors have is still on valuation. So even FIIs, when we talk to them, their concern is that Indian equity markets have not corrected as much as the other US, Europe, and other Asian markets. So if you see the valuation for the Nifty, the 1 year forward P is around 17.6, which is close to its long-term average of around 18 times, right? So valuations are reasonable. They are not like very attractive. And even if you compare the earnings yield for the Nifty to the 10-year GSEC yield, which is called the yield gap ratio, you can see the chart below that it is also close to the long-term average. So again, both these indicators are showing that the valuations are reasonable. They are not like highly attractive right now. And lastly, on the flows, we, like I mentioned, FIIs have withdrawn a lot of money from emerging markets, including India. So year to date, we have seen an outflow of about $25 billion, but it has been completely offset by domestic investors, both through mutual funds and to direct investments in stocks. So we have seen an inflow of about $25 billion, right? So that is one of the main reasons our equity markets have not corrected as much as the foreign markets. So what can we expect from the markets, right? So like I said, the outlook for growth has deteriorated globally. So you can see in the chart on the left hand side, the projections for India, China, US, Germany, Japan have come down consistently over the past 6 months, right? So for India, the real GDP growth rate has been downgraded from 6.7% to 7.1% for this fiscal year. For China, it has been downgraded from 5.2% to 4%. For US, from 3.9% to 2.5%, and so on. So in all countries, the growth estimates have been downgraded. On the other hand, inflation estimates have been increased, right? So in India, the inflation for this fiscal year is expected to increase by 6.7% from the earlier estimate of 5%. Same thing in the US, from earlier estimate of 4.5%, it is now expected to be 7.5%, right? So growth expected to slow down and inflation expected to increase. So what can we expect in this scenario? So we did a study. We try to see, okay, if you look at the past 15-20 years, when has such a scenario arisen and what happened to the markets in that case, right? So what we saw was there were 17 times when there were such scenarios, and typically, the market corrected during these times, and the average duration of the correction was about 2.5 months, about 65 to 70 days. Okay, and the average correction of the Nifty was about 14 to 18%, right? And currently, what we have seen is that the markets have been in correction since Jan actually, but you can say maybe for the past 3 to 6 months, right? So correction has been extended. Nifty from its peak had fallen down almost 15-16%. Currently, is down about 8-9%, right? So what can we expect? So as you can see, typically in the past corrections, Nifty on average fell about 17-18%, but it recovered the fall completely over the next 3 to 6 months, right? Same thing for the Nifty mid cap or the bank index, right? And the other indices. It's clear that after a correction, whether it's the broader markets or the sectoral indices, they recover whatever the loss was over the next 3 to 6 months, right? And that's a good sign. So what that means, is that in the current environment of slowing growth and high inflation, the correction that has happened was expected. We can expect, over the next 3 months, as the uncertainty improves, the markets to remain range bound. But, within 6 months or slightly after that, we can expect the markets to recover whatever the losses have happened, right? So hence, what is our view over the medium to long term? So like I said, we expect earnings growth to be about 13 to 15%, which is higher than the long-term average. We expect valuations, which are currently at the long-term average, to valuation multiples to expand from there. We expect a recovery in the FII flows, because if India is giving better visibility to economic growth and earnings growth as compared to other countries, then FIIs will find India to be a more attractive destination, right? So if FII flows come back and domestic flows continue to be strong, that should support markets. So on a medium to long-term basis, we remain positive on Indian equities, and we expect that markets will continue to scale higher even from current levels. So our narrative for India, the medium to long-term narrative, remains intact. And if earning grows at a 13 to 15% CAGR and valuation multiples recover a bit, we can expect equity markets to also deliver a return in that same 13 to 15% per year range over the next 3 years. So our recommendation for investors is that in any case they should continue their SIPs, and if there is a correction, then they can invest a little bit more aggressively. They can put in some lump sum also to add to their equity exposure, because like I showed you, data clearly shows that even if there is a correction over the next 3 to 6 months, market recovers the loss, right? And we can expect a good return over the next 3 to 5 years. So in terms of the themes, there are 5 themes we are interested in. One is the banking and financial services. So if India's economy does well, we can expect that sector to do well as the credit growth will improve. The second is a revival in real estate. Over the last year, we have seen the sector recover, and that benefits various associated sectors, whether it's cement, steel, paints, consumer electricals. All these sectors do well if real estate does well. Of course, given the rise in interest rates, as the EMIs will increase, that will impact some demand for residential real estate. But from the discussions we are having, we believe that real estate should still hold up. The third theme is discretionary consumption. We're already seeing that this is increasing as people are moving out of their homes after COVID, and they are spending more. So we expect, for example, the low-ticket consumer durables, the auto sector, retail sector to do well. The fourth theme is domestic manufacturing. So many of the industrials and capital goods companies have benefited from the production-linked incentive scheme. Their order books are giving very high visibility, and hence we like that sector. And the fifth theme is, of course, digital and tech. We've seen the kind of impact that sector has had on our lives over the past 2.5 years. Even corporates have increased their spending to upgrade their IT infrastructure, and we think that digital will be a secular theme over the next decade. So these are the 5 themes we are interested in. Now, we looked at the market outlook. We have some sense of what the market behavior could be over the next 6 months or the next 3 years. But now, what we need, the next step is to put together a good team, right? So, for example, in this year's IPL, we saw that the Gujarat Titans came out as the champions, right? And there wasn't like a real, well-known kind of, cult figure in that team. But as a team, everyone contributed, right? In every match, one or the other player did well and made sure that they crossed the line and won the trophy, right? And in the same way as investors, what we need to do is, given our understanding of the market, we need to put together a good team, a good portfolio of mutual funds that can deliver in different market conditions, right? So, for example, our recommendation on the equity side is, given the high volatility in markets, almost 35 to 40% of the equity exposure should be to diversified funds. And there you can look at our ABSL Flexicap fund. Then around 15-20% or more could be to a large cap category. And there you can look at our Frontline equity fund. 15 to 20% exposure can be to mid and small cap category. You can look at our mid cap fund, because if India's economy does well over the next 3 years, then mid and small caps will also do well. And lastly, 15 to 20% exposure can be to the thematic category, where you can look at a banking and financial services fund. We expect that sector to do well over the next 3 years. And of course, in the current environment, there will still be investors who will be concerned about volatility, who may want to remain on the sidelines. But for them, we suggest that they can look at a balanced advantage fund or our asset allocator fund, because the volatility in these funds is much lower, and they can give a better risk-adjusted return, right? So for first-time investors, for investors who are afraid of high market volatility, they can look at the balanced advantage fund or our asset allocator fund. So I'd just like to highlight or spend a little bit more time on the 2 flagship funds. So one is the ABSL Frontline Equity Fund. It's managed by Mahesh Patil, who's our CIO. This fund has an exceptional track record. So over the past decade, it has given a 19% CAGR return. You can see the table on the right that in almost 14 of the past 17 years, this fund has ranked in the first or second quartile. That means it's in the above the median. It's in the top 2 quartiles consistently, and that's because Mahesh manages this fund in a very disciplined manner. So the fund invests about 80% in large cap stocks and about 20%, up to 20% in mid cap stocks to get the growth exposure. It's a very well diversified portfolio, and Mahesh manages in a very disciplined way relative to the benchmark. So the sectoral weight relative to the benchmark is within plus or minus 5%, and that ensures consistency of performance. And you can see, like, even if you look at for the past year, this fund has done very well. The fund is overweight on sectors more on the domestic facing side. So whether it's telecom, consumer durables, for pharma, auto ancillaries, banking and financials, or cement, these sectors have done well and contributed to the fund performance. And the fund is underweight now on the oil and gas sector, on IT and consumer staples. The second fund I'd like to highlight is our Flexicap fund. So this fund has the flexibility to invest across market caps and across sectors. It's managed by Anil Shah. And again, this has a stellar track record. So over the past 24 years, this fund has given almost 22%, 21% CAGR return. And you can see on the table on the right that in a majority of the years, this fund has been in the first or second quartiles, that is above the median, right? So here, again, Anil manages this fund in a very disciplined manner. About 65 to 70% allocation is to large caps, and the remaining is to mid and small caps. His philosophy is to look at both the top-down and a bottom-up approach. So Mahesh follows what is called a dark philosophy, growth at a reasonable price. Anil has a slightly value tilt, and if you see the portfolio, it's overweight on sectors like pharma, telecom, chemicals, banks, industrials, and media entertainment, and it's underweight on oil and gas, auto, consumer staples, power, and other sectors. Just to highlight, for example, given the value orientation, Anil had taken exposure to the metal sector before the rally in metals happened for the past 6 months, and that benefited the fund. Then during the COVID crisis, when sectors tied to the reopening of the economy, like the multiplexes or the airlines or the hospitality sector, which got hammered, he took exposure to those sectors, and now those sectors are doing very well. Those stocks are doing well, so he's benefited from that also, and that has contributed to the fund performance. So these were the two flagship funds I wanted to highlight. But as investors, the story doesn't end there. I just wanted to spend a few minutes on asset allocation. If you see the data for the past 5 to 10 years, it's clear that it's very difficult to predict which asset class can do well. Like for example, calendar year 17, you can see domestic equity did the best and delivered 38% return. Calendar year 18, it was fixed income and gold that did well. Equity didn't do that well. Calendar year 19, it was international equity with 31% return. Calendar year 20, during the peak of the COVID crisis, it was gold which gave 27% return. In calendar year 21, it was domestic and international equity. This calendar year, as we are seeing, equity is not doing well, whereas other asset classes are doing well, right? So the point is that you can't just stay invested in one asset class and expect consistent returns, right? So in that case, you may see positive return in 1 year, negative return in another year, and so on. And hence, it's important to follow this mantra of asset allocation, because even if individual asset classes are volatile, the diversification across different asset classes helps you, right? So even, for example, let's say if domestic equity doesn't do well in 1 year, maybe international equity does well or gold does well, and hence that ensures that as a portfolio you get a consistent risk-adjusted return, right? So that's the objective of asset allocation. So here, if you see, we covered domestic equity. International equity, if you see, even after the recent correction in the US, the 1 year forward P for the S&P 500 is still about at a 5% premium, right? So still valuations are not that cheap. Whereas if you see in Eurozone or in other parts of the world, the valuations are somewhat cheaper, right? So that's one point. And then if you drill one down deep, you can see the FANG stocks, which many investors are now knowledgeable about. We have seen a decent correction there. Almost each of the FANG stocks is down 25 to 40%. But if you see the relative valuation of the FANG stocks relative to S&P 500, you can see that they are cheap, but they are not outright cheap, right? They have still not fallen below the long-term average. If you go one level deeper, if you look at fintech stocks, global fintech stocks, or unprofitable tech stocks, there you will see a much more correction. So these stocks have fallen 70 to 80%, right? But there is a chance that they can go below that also. They may not have bottomed out as rates increase and liquidity reduces, right? So we did a study of the NASDAQ 100 companies, and currently about only 10% of those companies are trading above the 200-day moving average. And what we saw was over the last 25 years, this has happened 15 times, that less than 10% of the NASDAQ 100 companies are trading above the 200-day moving average, right? And in all these 15 instances, over the next 12 months, the average return from the NASDAQ was roughly 52%. So what that says, and just to clarify, over the next 3 to 6 months, the NASDAQ was still down in 12 of the 15 instances, but over the course of the next 12 months, it gave a positive return on average of almost more than 52%, right? So again, just like I said in domestic stocks, in international stocks also, now over the next 3 to 6 months, we may get a good opportunity to increase our international exposure, and that's one of the aspects of diversification. The other is fixed income. So as you know, rates are going up everywhere, even in India. So even in India, the yield curve has become quite steep. Given the expectation of rising rates, our recommendation is to remain at the short end. So ultra short term, low duration funds are the ones that we recommend. For investors who are willing to take some exposure to volatility, who have a 3-year plus horizon, we are recommending our debt index funds and our target maturity funds. And lastly, to end on gold, which is the fourth asset class, we have seen that last 2 years gold was doing quite well, but this year it's not doing that well. It's corrected by almost 15% of the last 4 months. The reason for that has been the rising rates in the US and the stronger dollar, which is negative for gold. But again, there are recession fears. There are also fears about the Russia-Ukraine conflict, for example, right? And higher inflation. So gold provides a hedge against geopolitical uncertainty, high inflation, and recession, right? So as a hedge against these uncertainties, it makes sense to have some exposure to gold, right? So one easy way to get an exposure to all these asset classes, so there I'd recommend that you can take a look at our asset allocator fund. It provides exposure to all these 4 asset classes: domestic equity, international equity, fixed income, and gold. Currently we have 42.5% exposure to domestic equity, about 2.5% to international. So the overall equity exposure is about 45%. We have about a 9.5-10% exposure to gold, and the rest is to fixed income. The track record of this fund is very good. Over the past 3 years, we have delivered a CAGR of about 12% with low volatility, and that's the objective essentially. So we want to deliver fixed income plus 3-4% return, but with very low volatility. So the overall risk-adjusted return can be better. So that's all I wanted to cover. Just to end, if anybody amongst you is a running enthusiast, I run marathons. So my role model is this Kenyan athlete called Eliud Kipchoge, and his motto in life is very simple, like discipline sets you free. So normally we think freedom means we should be able to do whatever we want. Nobody should tell us what to do, right? But as I explained to you, getting a sense of where the market might move, putting the right team in place, and following the principles of asset allocation with discipline is what will ensure success for us as investors. And hence, I would recommend that you keep these 3 things in mind as you go on with your investment journey. So I'll stop here and we can open the floor to questions.
Thanks, Mr. Vinod, for a brief update. I request all the participants, so please post your questions. There's a question box pool within from wherever you have logged in through your device or through your laptops. So you can write your questions, and I'll probably take them through Vinod for an update. So before Vinod, everybody takes on or share their questions. As you said during your presentation about the stocks or the sector weight where you are overweight or probably have position, can you identify some sectors where you are underweight or probably it's an avoid for you guys?
Yes. So if you see our flagship funds now, like I showed, for example, we are currently underweight on the oil and gas sector, right? So as the global economy slows down, we are seeing that, for example, Brent crude prices have fallen below $100 a barrel. So the demand for oil is expected to go down, right? So we had already seen a run up in oil and other commodities. Now, as the global economy slows down, we are underweight on oil and gas and metals, for example, right? We are also underweight on the consumer staple sector. So that sector has also seen some run up. There are some valuation concerns. It has experienced some concerns on margins because of the high commodity prices, and as commodity prices come down, they will see some benefit, but valuations are also already reflecting that, and hence we are underweight on the consumer staples or the non-durables, as we call it. Then on the IT sector also, the valuations kind of already reflect the expected demand growth that the companies might see. and there are some margin concerns, right? Because the wage growth is still very strong in the US as well as in India, and hence we are underweight on the IT sector. So those would be the key sectors we are underweight on, essentially oil and gas, metals, consumer staples, and IT.
Okay. Okay. So we have one question on the business cycle fund. If you can give some update and how things are there, because it's part of our recommended basket. So yeah.
Okay. Sure. Yes. So the idea when we launched the business cycle fund was to take slightly aggressive exposure and proactive exposure to sectors based on the business cycle, right? So, like I explained, late last year, early this year, when we were seeing a recovery in the economy from global economy from COVID, and the expectation that oil prices would go because of supply constraints, the commodity prices were going up because of the geopolitical conflict. So we were overweight on some of these sectors. So whether it was metals or consumer durables, auto, right? We were overweight on these sectors, and that benefited the fund. Now we see the cycle has changed, right? So earlier, so any economy goes through 4 phases in the business cycle, right? So as we had explained at that time, there is the expansion phase, there is a peaking out, there is a contraction phase, and there is a slump, right? And what is happening is now we are going through these phases in an accelerated manner, right? So last year, early part of this year, the global economy was in the expansion phase. Now we have already peaked out and we are already in the contraction phase, right? And hence the sectors that did well in the expansion phase are not expected to do well now, right? So we are changing the orientation of the business cycle fund also, where we are increasing some of the defensive sectors essentially, right? So there, if you see, we have increased the weight to, for example, the pharma sector. There we have increased the weight to the staple sector, and we are looking at increasing the weight to the IT sector, because that plays based on where we expect the business cycle to be over the next 3 to 6 months.
Okay. Now there is a question on the benchmark of Frontline. So now before commenting, before passing on that question to you, I just want to inform our investors, just to please understand, whenever there is a benchmark, you always track a fund manager performance basis the benchmark, and says how it is performing well. But normally what we have seen when I meet investors, like last week, I met some clients and whose portfolio in last 1 year was down 22%. There wasn't any benchmark for it, because it's an individual portfolio built across his own positions, whatever the customer has taken. So at least, though there has been volatility around the benchmark, there's no and this is not to defend anybody, but just to give you that comfort that at least if there is a benchmark, the probability of a fund to be around that benchmark is very, very high compared to an individual portfolio, where the variance are very, very high, because you don't track your personal portfolio at a benchmark level. Now coming straight away to the question which is being asked, Mr. Vinod, is the performance of Frontline versus Nifty 100 TRI index, and the concern from the investor is that it has not outperformed for some time, over a long time.
Yes. So see what happens. We have to go back to 2018-19, because it's not just about Frontline; it's about the large cap category of mutual funds. Because we get this question quite often, right? In terms of many of the large cap mutual funds relative to the benchmark, are they able to outperform or not, right? And will they be able to outperform or not going forward? So if you see what has happened, right, in 2018-19, like we know, there was a very polarized rally. Only 7-8 stocks in the Nifty were doing well, right? And even the rest of the Nifty stocks were not doing well. And because mutual funds by definition are diversified, right? So any mutual fund will have 50 to 60 stocks in the portfolio. Most of the large cap mutual funds underperformed the benchmark in 2018-19, and the relative underperformance was quite large, right? And hence, if you see today, the data shows that over the past 1 year, Frontline has been able to do better than the benchmark most of the time, right? And it may go up and down depending on the market movement. But over the past 1 year, it has been able to either beat the benchmark or be close to it. To recover the past 3 years underperformance might take a little bit more time. And that's the same story with the other funds in the large cap category. Okay, so this is looking at historical. Going forward, what we do believe is, of course, it's becoming more and more challenging for the large cap category to beat the benchmark. But there are still definitely opportunities. Like because outside of the Nifty 50, there are companies in the Nifty 100, like the rest of the 50 companies which can be bought by the fund managers. And as those funds, the companies do well, they enter into the benchmark, right? So the fund performance related to the benchmark improves. There are a lot of new companies that are getting listed, which the fund managers can invest in. So that can also help them outperform the benchmark. But yes, if we take a 3 to 5 year view going forward, it is going to become more and more challenging for the large cap funds to outperform the benchmark. But we do believe that, given the disciplined manner in which Mahesh Patil is running this fund, it has a good chance of outperforming the benchmark going forward. And why I say this is based on the data for the past 1 year, where we have most of the time, like I said, Frontline has been able to beat its benchmark.
Okay. There is a similar question. In fact, we have an investor who has been investing over last 10 years in Birla Frontline, and it's through an SIP. And he is also raising concerns on the sharp decline in the recent past, within 6 to 9 months. So is the answer same, or you want to add on something, or some probably some sector allocation which is yet to give an impact, where you are very bullish on, which though the weight versus you may be overweight, but Nifty has a different weight on it. So if you want to comment on that.
Yeah, so see, in the last 6 to 9 months, the Nifty itself is down, right? Like if you see, from the peak, it fell almost 17-18%. Currently, it's down, let's say, about 9-10%, right? So in that context, if the Frontline Equity Fund is also down 8 to 10%, it's really not that big of a deal. If you look at the sector overweight and underweight, like is shown in the slide here, Frontline Equity Fund is overweight on telecom, consumer durables, pharma, auto ancillaries, banks, right? And here, for example, some of these sectors, like banking and financial services, it has almost a 33% weight in the benchmark, and we are slightly overweight on that sector. So that sector still has to perform, right? So our expectation is over the next 2-3 years, as the economy does well, banking and financial services will do well, and that allocation will help the fund. But so far, that sector still has not performed, right? Same thing is with pharma. Given the outlook that global economy is slowing down, we will see some slowdown on the Indian economy also. Pharma is a good defensive sector to have in the portfolio, and hence we are overweight in that sector. But even the pharma sector hasn't really performed that well over the past 6 months, right? Consumer durables, like I said, we do expect discretionary consumption to improve going forward. So that's why we have an overweight on that sector. Given the concerns about the slowdown in the short term, it may take some time for that sector to do well, right? So this is in terms of the to answer your question, Abhishek, in terms of the sectoral allocation and how that might impact the performance of the fund. So there are a few sectors where we have positioned ourselves. Like, so normally when we position ourselves in this fund, it's not for the short term, it's not for the next 3 to 6 months, right? We like to take at least a 3-year view and position ourselves so that we enter at attractive levels, and then the fund can benefit as the sectors do well over the next 2-3 years. And that's how the positioning is. And that's why we are confident that over the next 2-3 years, this fund should be able to do well and outperform the benchmark.
Right. There's a similar questions on passive investing, or why index fund, and why or an active investing. So probably I'll try to answer that to the client. So this is totally your view about the market. If you want to understand what is passive investing and how passive, what advantages passive have, what advantages active have, probably you can get in touch with your RM. He'll brief out to you. Yes, expense is is one thing, but beyond an expense, there's an active management in a portfolio, which over the long run definitely has the ability to create an alpha. So so probably that's a very simple answer, because there's no barometer as in say, passive is better or active is better. The best is you only decide and allocate basis your understanding and the risk profile. So yeah, I'll move out from that question. There is your views are required on this advanced performance. There are questions on using advanced AI tools, or there are other technical tools which as an AMC which we use to identify momentum companies or something like that. So, is there something which is being used at Birla level and to gauge the performance or to pull up the performance, or it's primarily more of an art rather than apart from the basic filters which the fund house do? If you can throw some light there.
Yes. So see, as a fund house, we are more fundamental driven. So our philosophy is growth at a reasonable price, right? So we look at when we evaluate a company, we look at, for example, its business model, its market share, how much it can grow, right, in terms of revenue growth, margins, and so on. So that's the fundamental factor. We look at valuation, return on equity, return on invested capital, and so on. From a risk management point of view, we make sure that we kind of don't over allocate or under allocate to any stock or sector, right? So that is one aspect. We also do look at some technical indicators, but that's not the key driver. That is more to get a sense of the market levels, or where a stock is trading at, what could be good entry points and so on. Of course, we do have screeners that we use. There are various kinds of screeners. Some screeners work on fundamental factors. Some screeners may look at momentum and volatility. I'd like to point out that, for example, in our asset allocation fund, we use a model which looks at all these metrics. So the model that we use looks at valuation metrics like price to earning, price to book, and yield gap ratio. It looks at momentum indicators. It looks at volatility indicators. And based on that, it gives us a signal in terms of how much to invest to equity, fixed income, and gold. But at the individual stock level, like I mentioned, we are more fundamentally driven. The technical indicators are more of an add-on that we may look at. They are not the key drivers. They are more of an add-on that we use to look at in levels to enter or exit and so on.
Right. Thank you. There are no further questions, Mr. Vinod, and broadly, I think we are close to the time which we have. So thanks all our investors, all our customers who have taken out time and come over the call, and special thanks to all those people who have tried to raise their concerns. I believe your questions are answered, and we intend to keep on engaging with you so that you understand how things are moving. You can understand the perspective of the asset management company and how they are shaping up your wealth and doing the best available. So thanks, Mr. Vinod, for coming over the call. Thank you, everyone. We can close the call, operator. Thank you.
Okay. Abhishek, take care, everyone. Bye.